On August 9, 1995, Netscape went public. The night before, Morgan Stanley doubled the offer price from $14 to $28. On day one, the stock hit an intraday high of $74.75 and closed at $58.25, valuing an unprofitable 16-month-old company at well over $2 billion. By the end of 1995, the shares traded much higher. The Wall Street Journal noted it took General Dynamics 43 years to reach a $2.7 billion value. Netscape reached a comparable value in about a minute. Netscape did not start a valuation bubble overnight, but it was the cultural spark. The lesson Wall Street took away was the dangerous one: a good internet story could substitute for earnings. Policy then poured fuel on the spark. The Telecommunications Act of 1996 deregulated the industry and helped trigger over $500 billion of mostly debt-financed network build-out over the next 5 years. The Taxpayer Relief Act of 1997 cut the top capital gains tax rate from 28% to 20%, making speculative bets more attractive after tax. Combine that with falling mid-1990s interest rates, and you get a vastly larger pool of money hunting for the next Netscape. On December 5, 1996, Fed Chairman Alan Greenspan asked how anyone could know when irrational exuberance had unduly escalated asset values. The Nasdaq closed that day at 1,300.12. The remark briefly rattled markets from Tokyo to London, then was ignored. The Fed warned but did not raise rates or tighten specifically to deflate the market, a choice critics like Paul Krugman later attacked. Over the next 3 years, the Nasdaq roughly tripled. Here is step one of the snowball. U.S. venture capital exploded from roughly $8 billion in 1995 to over $100 billion by 2000. Technology and internet companies took more than 90% of 1999's venture dollars. Thousands of startups were funded with a single mandate: get big fast, profits later. That money needed a way out, and the exit was the IPO. In 1998, the Globe.com priced at $9 and closed its first day at $63.50, a then record 606% pop on roughly $5 million of revenue. In December 1999, Virginia Linux priced at $30 and closed at $239.25, a 698% gain, the largest first-day jump in history at the time. In 1999 alone, 117 IPOs doubled on day one, versus just 39 in the entire prior 24 years. Those paper fortunes gave insiders and early investors capital and confidence to fund the next wave. The loop reinforced itself. Flush with capital, .com spent to grab market share at a loss. At the January 2000 Super Bowl, roughly a dozen .coms bought ads at about $2 million per 30 seconds. Traditional valuation was abandoned for eyeballs and growth. By widely cited estimates, the Nasdaq's price-to-earnings ratio reached around 200 near the peak, far above Japan's bubble peak near 80. When the price of a thing depends on a story instead of earnings, it can only survive while new money keeps arriving. On Friday, March 10, 2000, the Nasdaq Composite closed at its all-time high of 5,048.62, intraday 5,132.52, up roughly 600% from early 1995. There was no fundamental news to justify the final doubling. The Three Common Palms spin-off had already shown the market had stopped doing arithmetic. At the close of Palm's first trading day, Palm was worth more than the entire parent that still owned most of it, an impossible negative stub value. That is the precise moment greed peaked. The reversal came fast. On March 13th, news that Japan had re-entered recession set off a global sell-off that hit tech hardest. On March 20th, Barron's ran burning up, showing that nearly half of about 200 internet firms had a year or less of cash. The same day, MicroStrategy restated revenue and fell about 62% in a single session. On April 3rd, a federal judge ruled Microsoft an illegal monopoly, wiping roughly $79 billion from the bellwether and knocking the Nasdaq nearly 8%. The mood flipped from greed to fear. Underneath the headlines, the funding tap was closing. The Fed raised rates 6 times from June 1999 to a 50 basis point hike on May 16, 2000, taking the target to 6.5%. Most .coms borrowed little directly, so the hit was indirect. Higher rates compressed the value of far-off profits, and they signaled the end of the easy money mood the boom ran on. Whether the hikes caused the crash is debated, but they removed support just as confidence cracked. On April 14, 2000, the Nasdaq fell about 9% in a day, capping a roughly 25% week as tax bills and margin calls forced selling. The death spiral had begun. Pets.com IPO'd in February 2000, spent about $1.2 million on a Super Bowl ad against roughly $619,000 in first-year revenue, and was wound down starting November 2000, about 268 days after its IPO, with full liquidation completed in early 2001. Webvon raised hundreds of millions, planned a billion-dollar warehouse build-out, burned through more than $800 million, and failed by July 2001. At least about 1,100 internet companies went bankrupt. Once the stock fell, fresh equity disappeared, and firms with no path to profit simply could not refinance. The equity crash spread into the debt-financed infrastructure layer. Over $500 billion of fiber had been laid, and by mid-2001 industry estimates put the vast majority of it, as much as around 95%, unused or dark. Over-leveraged carriers collapsed. Global Crossing went bankrupt in 2002 with about $12.4 billion in debt, having booked capacity swaps as revenue with no cash changing hands. WorldCom revealed an accounting overstatement of more than $3.8 billion and filed the largest U.S. bankruptcy to that date. Global telecom stocks lost more than $2 trillion. The Nasdaq bottomed in October 2002, down about 78% from the peak. Roughly $5 trillion in market value was erased. About $1.755 trillion had already vanished by November 2000. Even survivors were gutted. Cisco fell more than 89%, and Amazon fell about 92%, from $106.69 to $8.37. The index did not set a new high until 2015, about 15 years later. The lesson the survivors taught was patience and a strong balance sheet, not picking the bottom. The bust contributed to the official recession the NBR dated from March to November 2001, deepened by the September 11th attacks, with unemployment rising towards 6.3% by mid-2003 and a jobless recovery. The Fed reversed hard, cutting rates 11 times in 2001 from 6.5% to 1.75% and toward 1% by 2003, the cheap money many historians link to the next bubble in housing. Reforms followed the abuses. Sarbanes-Oxley in July 2002 forced CEO and CFO certification, and the $1.4 billion global analyst research settlement walled research off from banking after analysts were caught privately calling stocks they publicly rated by junk. Here is the chain in one breath. Cheap capital, a powerful narrative, IPO pops, growth at all costs, cash burn, then a liquidity squeeze that runs the whole loop in reverse. Echoes are visible now. By late 2025, the 5 largest U.S. companies were about 30% of the S&P 500, the greatest concentration in roughly half a century, and AI took about 61% of global venture dollars. The honest difference, noted by Fed officials, is that today's leaders earn real profits, unlike most 1999 dot-coms, though many analysts warn the AI build-out carries its own risks. The technology thesis back then was right. Most of the valuations in companies were wrong. The lesson for your account is the one the survivors taught. Diversify, avoid overconcentration in one hot sector, and think in years, because the market can stop doing arithmetic long before it remembers how. None of this is a prediction about any specific stock or about timing.